Katz, Sapper & Miller, which many of you would know is a leading consulting and accounting firm. And we've enjoyed the opportunity to collaborate with Katz, Sapper & Miller over the last year. And we're thankful to have Corey Masala. Corey has very thoughtfully assembled a group of individuals, which I'll let him tell you more about, who can provide some interesting insight and experience. Corey himself has a very significant experience base. He's played a key role in almost 350 transactions, advising on both the buy and the sell side. His experience set ranges from business consulting, audit, tax services, supporting private equity, with an emphasis on technology, alternative investments, restaurant, real estate, healthcare, apparel, financial services. I think you get the picture. It's my great pleasure to welcome Corey. Corey is equally comfortable in the boardroom and in the deal trenches, and I'm very much looking forward to this conversation. And I again encourage you to complete this survey. It will be very, very helpful for us. Not only will you get first peek at the results, but we think it will also be very helpful in us in engaging and keeping our constituency informed on your perspective. So please join me in welcoming Corey Masala, who will lead this session.
So I'd like to thank Roger and David for giving me the opportunity to moderate this distinguished panel. I'm a partner, quick intro about my firm. I'm a partner at Katz Sapper, and I lead the New York office, which is a 75-year-old firm, and now it's one of the nation's leading CPA firms, which is unique. What is unique about the KSM is its emphasis on the entrepreneurial spirit. Many of our professionals, myself included, have owned businesses and understand the complexities and intricacies of owning a business. We serve a variety of industries, including emerging businesses, financial services, healthcare, life sciences, manufacturing and distribution, real estate, technology, and transportation, to name a few. All right, today I'm joined by 4 prestigious transaction specialists, which their names are up there. Who's first? Caroline Young. Caroline Young is a partner at Hammond Kennedy Whitney & Company, where she's in charge of all divestitures. In that capacity, she has overseen the successful exit of over a dozen portfolio companies. Prior to joining the firm, Caroline practiced law, representing corporate defendants in complex commercial litigation, product liability, and malpractice cases. Next to Caroline is Larry Reinhardt. He's a managing director at Woodbridge International, where he heads up new business development. Larry has more than 25 years of experience as a financial professional advising entrepreneurs, middle market businesses, owners, and corporate executives on strategies to maximize their company's value. Larry has worked extensively in several industries, including manufacturing, distribution, business services, retail, and healthcare. Next to Larry is Amy Margolis, who is a principal of origination at the Riverside Company. As such, Amy is responsible for sourcing investment opportunities and overseeing the exit process for domestic portfolio companies. Prior to joining the Riverside Company, Amy worked for 21 years at Prudential Securities, beginning as an investment banker and then becoming a senior vice president and director of equity capital markets. And finally, Seth Elliott Wilson. Seth is the founder and managing partner of Head Hall Capital Partners, a middle market private equity firm focused on the transportation, logistics, and transportation distribution industry. Prior to founding Head Hall, Seth was a partner and managing director of Jefferies Capital Partners and its predecessors, where he worked for 20 years since its founding in 1994. And Caroline, you're first up.
All right.
To give an overview of the areas in which your firms invest.
Sure. So I'm a partner at Hammond Kennedy Whitney. It's a private equity firm in the lower middle market. We've actually been around for over 100 years. Started doing buyouts in the early 80s. We are currently investing out of HKW Capital Partners 4. We look for companies that are about 5 to 30 in EBITDA. We're generalists, but we have sector focuses, which include healthcare, infrastructure, and health services. Our mission at Hammond Kennedy is to acquire and build quality businesses by by partnering with superior management teams. And that's really what we do. We partner with our teams. Integrity, honesty, transparency are really important to our firm. And we don't go in and run our businesses, we help make them better. So I'm really proud to be a part of that company and in what we do. My role, as Corey mentioned, is running all divestitures. So I work with our company really from the date of acquisition, making sure we're doing all that we can to create value, enhance the company, address detractors, so that when it comes time to exit, which is when I really get involved, we do the best we can for our shareholders.
Thank you. Larry.
Larry Reinhardt, Woodbridge International. I'm the only non-principal up here. We're an M&A advisory firm, sell-side M&A, $1 million to about $15 million of EBITDA. Industry generalists, right now we have about 38 deals in the market. About 70% are in North America, maybe 10-15% in Latin America, the rest Europe, India, and Australia. So probably 90-95% of our clients are the founders, the entrepreneurs. So emotional decision for them often is more emotional than financial. So our objective is to get them as many viable buyers as possible to put them in a good mental place to make a decision. Right? So,
Amy?
thank you.
Amy Margolis from the Riverside Company. I'm a principal here in our New York office, and we are a global private equity firm, $5.6 billion in assets under management spread across 6 different fund families. And we feel that we're really the largest firm that's focusing on a global basis on what we call the smaller end of the middle market. So companies with enterprise values less than $400 million. We have a history of being generalists, although we do have several industry specializations. Areas that we focus on are healthcare, the services and devices side, franchising, the consumer sector, tech-enabled business services, software, and education and training. We have over 80 companies globally, and our goal is also to do our best to partner with management teams to help build companies, not just from organic growth, but also from add-on acquisitions once we acquire the company. And my role is on the sourcing side to help find opportunities for us to invest in, as well as overseeing our exit process. So similar to Carolyn, get very involved, not just in the beginning, but also when we exit companies.
Seth?
Yeah, I'm Seth Wilson. I'm the managing partner for Head Hall Capital. We are only a 2-year-old firm, unlike some of my colleagues. We focus on taking control positions in supply chain related businesses, so transportation, logistics, distribution, trucking companies, warehousing firms, freight forwarding firms, things of that nature. Primarily focus on North America, but we will look at some international opportunities. Also focus on the lower middle market, kind of 5 to 25 million of EBITDA, 25 to 200 million-ish of enterprise value. Prior to that, I was one of the managing partners for Jefferies Capital, which was a kind of a 20-year firm affiliated with Jefferies Group, where I ran the transportation investing practice there. About 25 platform investments over the years, kind of about $2 billion of enterprise value collectively.
Thank you. Thank you all. So our discussion today will be focused on the U.S. middle market, given that it's the most active sector in terms of the number of deals. But first, let's review the state of the market in 2016. Middle market activity continued to slow in 2016. Through the first 3 quarters, there were 1,330 transactions, which represents a 16% decrease in the number of deals from 2015, and a 9.7% decrease in terms of dollars. The median deal size in the middle market through the first 3 quarters of the year shrank to $129 million, which continued the downward trajectory from prior years. For 2014, it was $150 million, and in 2015, it was $133 million. Now, in the lower middle market segment, it saw 544 transactions, which is down almost 7% year over year. But the values of the deals have increased by 17%. I think there's no surprise there if anybody's active in this space. Add-on transactions have steadily risen post-recession
And in 2016, PEs have had the greatest percentage of add-on deals in the last decade at 64%. All right, there were 593 PE-backed exits through the first 3 quarters of 2016, representing a 20% decrease year over year. The most interesting trend is that 52% of these exits were secondary buyouts to other PEs. So there's a lot of movement between PEs these days. Given these changes in the market, we wanted to explore further how investors are sourcing companies and are closing transactions in this environment. Next piece I want to discuss is the survey that David discussed that we did with the M&A advisor. So the survey was sent to 100,000 experienced professionals with a variety of backgrounds, including executives, consultants, advisors, lenders, attorneys, investment bankers, and other service providers. You'll also have the opportunity to weigh in on it, which David already expressed. So please do and give us some additional feedback on your thoughts. But what I'm going to share are the preliminary results of what we found before today. The first survey question related to the greatest challenges buyers have had in 2016. A list was provided, and the survey respondents selected the top 3 to 5 challenges they have experienced. The results were interesting. According to the survey, the greatest challenge to buyers in 2016 is sourcing a company that is a good cultural fit. This would appear to be correlated to the high volume of add-on transactions, which supports the high percentage of add-on transactions for the year. The second greatest challenge is the owner's willingness to relinquish control. And the third greatest challenge is the target's requirements for integration or operational support. We asked survey respondents to rank how significant certain opportunities were in influencing buyers in 2016. As you can see, the most significant opportunity was building a company for increased revenues and profits, followed by investing in high-growth sectors and higher ROI. So here's the first question for our panelists. What challenges and opportunities have you encountered in 2016, and does this data align with your experiences? So Seth, I'll go from your direction.
Okay. I'll talk about things obviously in the context of what we've been doing, and one of the things you said actually did strike a chord in that. We had 2 opportunities this year where a company had actually gone out, hired an investment banker, run a process, entered into an LOI, and then both family-owned businesses, and they actually changed their mind. And it's a challenge to, I'd say, find these companies and get them across that final finish line, especially at the lower middle market, where a lot of the companies that we're looking at were entrepreneurial founded, and many of the factors that influence their decision process are not, black and white, right? Are there children in the family, or their names on the door? So I think one of the things we're facing is simply that there's this generational shift going on, and that should be an opportunity for us to step in. But many times, that becomes a equally large challenge in dealing with that.
Amy?
I would say that the biggest challenge for us this year has really been valuations. That we've got on the control side, we have 2 funds in the U.S. One invests in companies with EBITDA less than $7 million, and the other one is between 7 and 30. And I would say in the microcap fund, which is our smaller fund, we've seen very healthy deal flow throughout the year. So it hasn't been an issue of number of transactions, but in that fund in particular, we've seen very lofty valuation expectations on the part of sellers, as well as from competitors who are chasing the same assets. So that, I would say, has really been, I think, the biggest challenge for us. We see it the same. There's certainly been quite a bit of valuation acceleration for the larger cap companies as well that we look at. But in particular, we're finding a lot of PE firms that weren't necessarily playing in that lower end of the middle market have started to come down and look at several of these opportunities. So really, I would say competition is what we're seeing.
Larry?
So again, we're on the sell side, we're advisors. Deal closings for us are up this year. New client engagements in the second half of this year are a little bit down. There's some uncertainty. We're also starting to see the performance of some of these companies. I think what Seth was saying is always evident. They look at, this is my liquidity event, I'm going to get this 10, 20, $30 million, but then what do I do with the money? And what do I get return? Right, I want to change my risk profile. So there's been some of that. Our challenge, we got into Brazil 2010, 2011. We had a lot of success down there. So our challenge as a company now is finding buyers for our sell-side mandates in Brazil, right? Which is also an opportunity. Globally, we've expanded. So we sold our first business in Costa Rica this year. We sold our first business in Germany this year. We sold our first business in Australia this year. So what we're finding is, from an origination standpoint, we have less competition outside of North America. So for us, it's been a good opportunity, good decision to go abroad. And Brazil will change, right? So.
Caroline?
Yeah, I would agree with Amy that really valuations has been one of our biggest challenges. There's just a lot of competition. There's bigger funds coming down. There's a lot of money out there looking for a home. So valuations are certainly up, especially in sectors that have less cyclicality and more recurring revenue. Challenges are also opportunities. So as a private equity fund, that's an opportunity on the sell side. Cultural fit, for us, that is one of our strongest points. Our ability to really connect with, particularly founders who are considering a sale, given our partnership mentality, that's really been an opportunity for us. On the sell side, I think, sometimes if you get some of these PE groups that aren't as good at connecting, that can be a challenge, getting our management teams comfortable with these buyers coming in. But
So that's your edge.
yeah, that's our edge.
So I want to stick to, so let's talk about sellers for a second. Amy, you want to give a sense of some of the challenges with the sellers when you're trying to work these deals. You like the company, but all of a sudden all these nuances come up with the sellers, whether, I've experienced it where there's a number that they're looking for before they'll move forward on a net basis, but they never share it with you sometimes. So, go ahead.
Yeah, that's certainly a challenge for both bankers and advisors to the sellers, and oftentimes, especially with add-on acquisitions, we may be working directly with a seller who has not hired an outside advisor, and just the expectations, getting them to the table, getting them comfortable that we do want them to stay on, or whatever their reservations are. So I think getting back to that cultural fit is very important. But I think seller's remorse is always something at the end where this has been their baby. This is a company that they've had in their family. They don't have someone potentially to take over, and can they really let go? And so I think that's one of the biggest challenges for us. And then I'd say, the other challenge that really goes hand in hand with that is when we were talking about valuations. They see larger companies that are getting these crazy valuations and feel my company's just as good as theirs. So, that's my expectation. So, just getting people to understand why they may be different from a company that's in the same industry but larger, and why they don't necessarily deserve or can get the same valuation. So that, both of those issues are things that we go through quite extensively. But on a positive note, we partner with entrepreneurs all the time. And this year, if I look at, we've closed 30 transactions on the buy side, and roughly 80% of those have been add-ons, and many of them have been entrepreneur-owned companies that have been bolted on to our existing portfolio companies.
Caroline?
Yeah, add-ons have been a big push for us as well, and they tend to be smaller companies where, there's different challenges for these smaller companies. Often they don't have the numbers, down pat. They maybe haven't put as much time into their forecasts or don't have the audited financials. So that always creates their own challenges, but also opportunities to get in and help them and to integrate them in a positive way.
Well, it also gives you an edge, except they want that net number.
Yeah, there's definitely there's a couple of our companies that we acquired with a thought of acquisitions, and the lofty multiples people see out there, it's been a challenge for us to get people to realize that if you're a quarter the size, you're not going to get that same multiple. And there's been a number we haven't been able to get to a finish line because of that.
Yeah. Larry, you're on the sell side, so
Yeah.
you're out there trying to get them ready.
It's 90% of my time is educating people on realistic. I mean, we talk to 1,500 companies a year, and then of the 1,500, there's probably 600 that are large enough, and of the 600, there's maybe 100 we want to pursue because we feel they're realistic, right? So you just need to, you can't make everybody happy. But that being said, you try to flush them out in terms of realistic deal scenarios. But like Amy was saying, the emotional part, the moment of truth comes, and they say, wow, I didn't think this was possible. You really are going to get me this 20, now what do I? So we had a situation in Arkansas, it was a medical practice. We told him somewhere around 20 million of value. He said, great, let's go. So we went to market, we got significantly better. He just stops talking to us. And so he resurfaced and he said, I realized I'm 46 years old. If I see my wife more than 5 hours a day, I'll end up getting a divorce. Right? So you're always going to get some of that. But that's why our philosophy is let's try to get people that are realistic on the front end, show them the world so we can say we went to the world, right? We went to thousands. We got 100 books out. We got 10, 15, 20 offers. We didn't put a price tag on it. This must be what the market's saying, right? So.
And Seth, you're industry focused, so give us what you're seeing with your
Yeah, so I'd say it's interesting that you made a couple of comments about the add-ons, and that one of the unique things that's going on in the transportation industry is that the government deregulated transportation in the 1980s. So if you were the hotshot, unique, smart person in 1983, started a company, grew it, and now you're in your 60s or 70s. And so we're seeing a lot of opportunity and trust me, most people don't wake up and want to go run a trucking business, right? So, so the second generation is usually not there. So we're able to step in and be the kind of knowledgeable industry experts who can help them with that transition. We've been lucky, at least in the deal we closed last year and the deal we closed this year, we found situations like that where the seller just wants his retirement money, and he has a number in mind, a net number. And so the negotiation is, okay, tell me your net number first, and then I'll back into whether it makes sense as a multiple of EBITDA. And in both cases, I think we got them at a discount because they were thinking dollars in the bank as opposed to what my company's worth. So that generational shift, I think, also it will drive a lot of M&A activity in the transportation sector. And great for add-ons. Our portfolio company recently bought a very small add-on, and it was literally just pay me for the value of my equipment and my inventory, and because I just want to go fishing. And that translated into a 2x EBITDA multiple. So we kind of ran to the finish line. So
that works pretty well.
Yeah, so I think there'll be, I don't know the statistics, but I think the supply chain sector will be pretty fruitful for the next couple of years, driven by that kind of generational secular change that's going on.
That's great. All right, so our survey asked which trends M&A professionals are encountering most frequently as we approach 2017. Not surprisingly, increasing business valuations and higher EBITDA multiples was the #1 answer. That was followed by increasing volume of industry consolidations and decreasing debt multiples. Median debt percentages are down this year compared to the last 3 years. Question, do you think EBITDA multiples are affecting the debt ratios? If not, what is? And this is going to be quick because this is going to be fast answers, I'm imagining. So Seth, you want to hit that?
Yeah, I think, the lending community has a bit more restraint than the buying community at this point. So as multiples expand, there's somewhat of an artificial cap on how much debt you can bring on to finance a transaction. And that's leading to higher equity ratios in deals.
Amy?
Yeah, we found, especially in the smaller end of the middle market, there's no shortage of capital. So lenders have been very aggressive in our end of the market, and obviously that's had an effect on valuations.
These rapidly growing companies in Brazil are hiring us is because they can't, for them to finance their growth with senior debt, it's prohibitive, right? So that's why a lot of them go to market. So.
Yeah, there's definitely a lot of debt out there to be had. We tend to take a little bit more conservative approach and don't usually max out what we could max out. And I think that lenders know that we're a little closer to a recession, and we got to be getting closer. This is going for a long time.
Yeah,
so
and
they're
the
getting a little more
valuations
careful.
are up there too.
Yeah, so they're watching it.
So, in your experience, what are you seeing in terms of increasing volumes of industry consolidations? Is anybody want to grab that one?
As we're
You're the guy.
seeing a tremendous amount of it in the transportation sector, driven by the generational change that I just mentioned, but a lot of government intervention. A tractor, the power unit that drives a trailer over the road, if you go back 7 years, was probably a $90,000 asset. With a lot of the government intervention on environmental regulation of emissions, that's now a $150,000 asset. So if you're a small trucking company, and there are hundreds of thousands of trucking companies in the United States, your capital replacement cycle just got pushed out of whack. In addition, there's a lot of regulations around what drivers can and can't do, making it harder to be a smaller business. And those companies are just selling or shutting down. So I think there's you're going to see, if you go back over the years and say, what did the railroad industry do over the last 100 years? They went from lots of small ones to now kind of 4 big ones in the U.S. And generally, I think that consolidation is a helpful thing, for the industry, where you saw on railroads, operating margins go from 20 to high 30%, and return on assets go very strong. But for those of us up here who are lower middle market private equity firms, what it really means is that there will be buyers for the businesses that we are doing the hard work of convincing the entrepreneur to sell and putting in the processes and making it a real business, that there will be buyers down the road for what we're doing. So as a backdrop over a long period of time, it's a positive from both an operational umbrella and an exit, would be my take.
Caroline, what in the industries that you're?
Yeah, I mean, we're really focused on add-ons. Organic growth is great, but you can really increase your returns if you can get some add-ons done. So I think you're seeing PEs focus on those areas where consolidation makes sense. And you also have strategics who still have a fair amount of cash on their books, and they're pretty active as well. So you're seeing that competition there.
Amy?
Yeah, I was going to say, we're certainly seeing consolidation across several different industry sectors, but importantly, the strategics have been knocking on the door more and more. And I think, the luxury I think that we have in the middle market is that these, companies, whether they be public or large private companies, they're sitting on a lot of cash. They need growth opportunities, and the middle market represents terrific opportunities for them. So I would say this year in particular, we're seeing that trend accelerate.
Larry?
Yeah, for us recently, it's been consolidations, healthcare, and really we sold a small little company in New Jersey. Went for a significant multiple. It was a Korean public company that came in, medical lab testing, and then food. We're starting to see a lot of interest from overseas buyers in North America. We have interestingly, a shrimp farm in Central America that's getting a ton of interest from China, right? So, right, who'd have thunk it?
Great. So some claim that the higher multiples that I was going to refer to, we've heard as high as 13 times, are due to increased activity in the IT and healthcare sectors, which generally tend to trade at higher multiples than other sectors. Another one of our polling questions, we're asking, rank the hottest industry sectors for the up and coming year. So technology, healthcare, and financial services were ranked among the hottest sectors. Does this match that we just discussed it, we went consolidation, but now let's talk about hot sectors and high multiples. Does this match your experience of what you've experienced in the past year? So Amy, you want to grab that?
Yeah, sure. Definitely matches our experience in the technology sector. We're doing a lot in the software, SaaS platforms, tremendous growth opportunities there. In healthcare, anything that is cost containment, health and wellness is also an area that I would say kind of crosses over into the consumer goods sector as well. and fintech. I think, those three sectors, there continues to be strong growth opportunities, significant demand, both on the part of, from buyers, not just PE, but also strategics. So those definitely would be I would say probably the most active.
Larry, you want to grab that?
Sure. Yeah, going down the list there, I would agree. Financial services, we sold a company that did automobile warranties, went for a significantly higher multiple than we thought it would go for. And I mean, there's also just random roll-ups or consolidations and things you never thought of, like a company that remanufactures old circuit breakers, right? That went for, so look, one thing we've learned since we've gone global is that as dysfunctional as the US is, everybody wants to be here. Everybody wants to buy companies here, they want to grow companies here. So we bring a company to market in the US, you bring that same company to market in Europe, you just don't get as much interest, right? So there's always different kind of consolidation things happening here in the US.
Caroline?
Yeah, we do not play in the technology space. Healthcare for sure is high multiples. I was a little surprised to see energy as fourth, but I do think that will come back, but I'm not seeing it quite yet. But yeah, I think that would be consistent with our view of the hot sectors.
Okay. So the last question we were asking in the survey was, which factors could have the greatest effect on M&A growth in 2017? And the two most common responses, because these were written answers, was political administration. So remains to be seen, because the expectations have changed, and increasing U.S. interest rates. So looking into 2017, what do each of you? How do you see the money being deployed in the challenges? And I added 18 for a reason, because out there some people are saying 17 is going to roll, but 18 is where the issues are going to start. So Caroline, you got that smart. You look like you're ready to fight this one.
Jump out the door. I think 2017 will be relatively similar to 16. A lot of investment bankers I talk to see their deal flow going down a little bit, which is consistent with what this year's been. I think if interest rates go up, they're not going to go up a ton, and I don't see that as a huge factor in our industry. Especially after this morning's conversation, I think one of the challenges, and this isn't necessarily a challenge in buying a great company, but a challenge for all of us in this room, especially those in PE, is sort of the populist view and the negative view that PE has. And as a former litigator and now private equity person who's certainly got a lot of negative press on both counts, we do so much for the positive in terms of helping companies grow and be better. And I think it's incumbent on all of us to get out the word in a positive way.
Well,
but I think that's a
if we
for
would
all
have
of us.
had different results,
I would have said
the wrath would be coming.
Yeah, we'll see.
There's a potential here for some changes.
Yeah.
So, Amy, you want to jump on that?
Yeah, I think we would feel similarly. We talk to bankers every day, and if you look at their pipelines, fairly steady. So we would expect to see similar environment for deals for next year. Interest rates, I think we all feel rates are going up at some point, but not dramatically, and there's continues to be a lot of capital available for the types of deals that we're doing. Our size deals, I think for all of us up here, don't run into much in the way of getting outside of capital requirements. So we're not faced with any of those issues that you read about with some of the larger LBOs out there. As far as, I think that the challenge is for all of us, who are sitting up here, we have a buy and build strategy, and we want to continue to do that. And I think to Caroline's point, that we're doing good things for the economy. We want to continue to do that. So the negative vibe towards PE is something that we all work hard to try to dispel on a daily basis.
Seth?
Yeah, I think you hit the nail on the head, whether it's the 12-month or 24-month period, but investors like to have a sense of what environment they're buying into. And I think with uncertainty, over the next 2 to 3 years, people will be a little more hesitant to transact. There's still a lot of money they still have to transact, so I won't say that deal flow won't happen, but I'll give you an example. We have a company under LOI that is significantly tied to the export grain market. We now have a president coming in with a protectionism mindset. I have a 5 to 7 year hold period. How do you get your hands around the impact that it might have on export grain volumes? I don't know. You don't know. No one knows, right? We have a portfolio company that's an international freight forwarder. Is there going to be significantly more or less shipments coming in and out of the United States? I don't know. And I think stability of that backdrop is a fertile ground for M&A, and that's the one thing that I might upset the apple cart in people's willingness to deploy capital.
Larry?
I guess, me and my partners, well, one of my partners in particular is a little bit paranoid and is wondering, are we in the 9th inning of this recovery? And maybe 2017, we're going to start seeing things trend down. What's helped us as a company is just the global diversification. So, we are seeing originations slow down up here in the United States, but down in Latin America, we've been seeing them increase. There's a lot of optimism now in Argentina. Supposedly Brazil's bottomed out, and then we're seeing some uptick in Mexico. So for us, that's kind of how we've, kind of balanced things. We no longer will do, 95% of our engagements are sell side. We will no longer take on engagements if somebody wants to buy in the US because it's so trafficked over here, right? If you want to buy in Europe or Latin America, that's great. There's less competition, so.
That was great. Each of you avoided telling us when they think their downturn is. That was good, though. It was the way to go. So
February 16th
right.
at 11:02.
If we knew that, we wouldn't be sitting there.
Exactly.
So the last question and a quick one. There's been a ton of funds raising money this year. Everybody's been able to get new funds started. There's a lot of dry powder. With all this uncertainty and this competition, you just talk about 17 and because you kind of hit it a little bit where you're saying you have to be a differentiator in how you handle the sellers. Just give us your views of how you're going to stay ahead of everybody else.
Well, sourcing is incredibly important, and I'm blessed to be with a firm. We've got 3 full-time people out on the road all the time, and the ability to find those less well-marketed companies is just going to be a really important differentiator for us. And those are usually the founder-owned businesses, which again for us plays to our strength. So that's what we're focused on.
Thanks. Larry?
For us, it's 2 things. It's, again, global. I'm trying to learn Portuguese. But then the other thing is, from our perspective, the U.S. is still the best place to sell companies, so we're spending more and more money on more marketing. We do a lot of direct marketing and, being able to penetrate. And it's the funnel. The more business owners we speak with, the better engagements we're going to have. So.
Amy?
As Caroline said, it's finding those opportunities that aren't being sought after by a million of your competitors. It's being able to deliver performance, to continue to grow companies both organically and through add-ons. And we closed on a deal this week with a company that we had paid an attractive valuation for, but more than tripled EBITDA in 4 years or less than 4 years, and had 3 to 4 times revenue growth during that same time period. Those are the types of things we're going to have to do for our shareholder base and for our management teams in order to really justify the valuations that you have to pay in this marketplace.
And Seth?
Yeah, I think I would echo that. It's sourcing, and building the funnel is clearly the best approach to being able to deploy capital attractively. And I'd say the second thing is my partner for 20 years had started his career as a research analyst, and the way he would describe it, I think we've gone from kind of a macro investing model to a stock picking model, which means that you're going to have to look for the story. You're going to have to look for why this company is going to outperform. What's the unique aspect of this business, and not as much rely on just buying a company in healthcare that's growing. It's got to be the right company with the right management team and the right situation And I think that stock picking mentality is what you got to switch to.
Excellent. All right, well, let's thank our panelists.